In Asia were mixed as data showed accelerating Chinese factory activity growth in December. Meanwhile, shares of debt-laden China Evergrande briefly surged more than 6% after resumption of trading following yesterday's halt before giving up some of those gains. Hong Kong's broader Hang Seng index fell 0.1%. Mainland Chinese stocks also declined, and elsewhere the Nikkei in Japan climbed 1.7%. European stocks opened higher as most major regional indexes pushed higher on the first trading day of the year. Stateside, Tesla and Apple were bright spots of yesterday's trading day, Tesla adding 13.5% after the firm beat fourth quarter and full year delivery expectations. Apple briefly touched a $3 trillion market capitalization after rising 2.5% to a new record. That's as big as Facebook, Coca-Cola, L'Oreal, Netflix and Nike put together. But to talk to us about other developments happening and specifically focusing on the retail shares for 2022, we are joined by Chris Gilmore, who is an independent analyst at Salmore Research. Chris, thank you so much for your time. So it's quite interesting because as we wrapped up the year, you wrote a very interesting piece looking at what was happening with the retailers. But let's talk about the retail performance that you're used to seeing versus the current retail performance that we're seeing when we look at the charts now.
Good afternoon, Nastasia. Yeah, look, if you go back historically and look at the kind of ratings that the retail shares have been on, they were very, very glamorous ratings indeed, well into the 20s. And that is because they were coming out with fantastic earnings growth, 20% plus for most years. And across the board, we're talking about the food retailers, the furniture retailers, which aren't so many left these days, and of course the clothing retailers. That's all changed, and not just because of the pandemic. It was slowing down long before then anyway, and that is reflecting the slowdown in the South African economy. But the pandemic has really taken its toll on the retailers. I mean, if you go back and look at the kind of growth rates that the retailers have been exhibiting over the past 5 years, is very, very poor indeed for most of them. There are one or two that are some bright, shining examples of really good performance. And ShopRite sticks out. But other than that, there aren't too many. So, it's not an area, it's not a sector, I think, that is going to be particularly in vogue from a fundamental perspective. Having said that, there are certainly certain shares, and I'll pull out Clicks, for example.
Yes, we actually have the Clicks chart as you speak about it, so we're going to put it on screen. So let's talk about Clicks, because that one up 20% year to date. What's interesting about that one?
Yeah. Clicks is a fascinating company. I mean, it's a very, very good company. Make no mistake, it's incredibly well run. It's in the right sector. People are always getting sick. And it provides a phenomenally good service, particularly when it comes to their wholesale pharmaceutical side. And, they produce reasonable earnings growth. Not fantastic, and they've never really shot the lights out. And yet, it is the most highly rated share on the JSE on a PE ratio of 41 times. I'll say that again, 41 times. It's phenomenal, isn't it? Now, DIS-CHEM, its peer in the market, which again has had poor earnings growth in the past few years, that's not far behind, 39 times PE. I think people buy it because they figure that for these companies, slow and steady wins the race. But there's no fireworks with these companies. Look, I think Clicks may be in a nice position as the year progresses. They've stated their ambition is to get heavier into the baby market, for example. And I think they're well positioned. They've got a nice market share, but they could do an awful lot better. So there are little areas that they can do better. But, it's a big ask to try and justify those rarefied ratings.
Yeah, so before we move to the clothing retailers, DIS-CHEM's quite interesting because that one up 68%, and we're going to put that chart on screen for the viewers to see. The share price movement for this one since 2017, does that make sense, or is the market seeing something else here?
It makes no sense whatsoever. The compound annual growth rate over 4 years is 1%. I mean, it's diabolical. It really is absolutely shocking. Again, a great company. And I must add that as a consumer, I love going into DIS-CHEM. I much prefer it to Clicks. It's got exactly the kind of goods that I want and at exactly the right price. It's phenomenal. I don't think they're as good as Clicks when it comes to the wholesale side. I think Clicks is definitely ahead of them. But nevertheless, coming back to the actual earnings growth, no, it hasn't been good. And you don't, it doesn't justify that kind of rarefied PE.
Right. So let's get to the clothing retailers. So we've got, the Foschini Group. We've also got Truworths, sitting in the background in terms of charts, and we're going to put them on screen. When you look at the three listed clothing retailers, I mean, Mr. Price, the Foschini Group, made some interesting acquisitions, and I suppose that's where you kind of want to be in an economy like this.
Absolutely. The Foschini Group, TFG, very clever. They held their cards very close to their chests last year with the Jet, which was part of Edcon. And right up to the last minute, they said, no, we're not interested. And all of a sudden they said, hey, guess what? We're buying it. And so they got it for an incredibly good price. In fact, they were effectively paid to take it away. So if you add in the value of the stock there. So they've done really phenomenally well. Foschini, the Foschini Group is kind of middle to lower end of the market, and that's where you really want to be in the languishing South African economy. So I think they'll do well there. They made the right acquisition. They've got a nice war chest. They've got plenty of cash in the bank, and it's, again, an incredibly well-managed company.
So between Pick n Pay and Woolworths, I mean, Woolworths, that one, it seems to have got itself into all kinds of problems in Australia. And I'm wondering, between the two, which one would you hold?
That's a difficult one, Nastasia. Look, Pick n Pay has disappointed for a long time now. Great company, well managed, but it's been in the shadow of ShopRite for the past 15 years now. It just doesn't get it right compared with ShopRite, in my humble opinion. As I say, I think if they can get more and more of their sales coming out of Boxer, their subsidiary, which is much more aligned to the low end of the market, then I think they'll do well. When it comes to Woolies, that's a very different kettle of fish. It's a beautifully run organization, but very much at the top end, and it has no real competition. Checkers has been trying hard to compete, and it's being very it's sustaining that competition. And if that remains, that will provide a bit of chipping away at Woolies at the top end. But I think in terms of cold chain, nobody can actually compete with Woolies. But having said that, Woolies, you can't just buy the food side. You have to buy a package. You have to buy the clothing, and you have to buy Australia. Yeah. I don't like Australia. I'm not wild about the clothing side. I love the food side. It's absolutely fantastic, but you can't unfortunately buy it, just the food.
So as we wrap up, we're introducing something completely different where we ask you your stock pick, and at the end of the year we see how the different stock picks that you've put forward have performed, and your stock pick is City Lodge. Why? Okay,
City Lodge, unfortunately, it got a bit of bad, how can I put it, bad press, if you like, because of the fact that they lost out when the South Africa was put back on the red list. That's all changed now, but they are having to rely more and more on local tourism. And that's only a certain size. The foreign tourists are coming back slowly, and we are right at the heart of the foreign tourist season. Their model is changing a little bit, more from corporate, more towards leisure tourists. From a valuation perspective, I'm valuing this thing at around about somewhere 8-9 rands a share. It's currently trading at about 5 rand, a bit over 5 rands. So I think there's probably a lot of upside. It's going to take a bit of time. It's going to be a slow, gradual process, I think. And the market needs to be convinced that all the bad news is out of the way. And I think it probably is. So provided you don't have another variant coming out of the woodwork and causing nonsense with lockdowns and the like, and provided the foreign tourists keep on coming, and then I think City Lodge looks like a nice one.
All right, Chris, thank you so much for your time. That is Chris Gilmore, who's an independent analyst at Salmore Research, taking us through his stock pick, but also taking us through the retailers for 2022. So as we wrap up, that is it from me. I leave you in the capable hands of